Everyone's always worried about interest rates rising, but nobody really understands why and how it affects equities and crypto. Well, what you're about to watch is going to answer that question.
Let's say you could go out and buy a bond that gives you 10%. Okay, so essentially, if you buy a $100 bond, by the end of the year, you're gonna have $110, right? So this is the base case. Okay, let's say you could do this. Okay, and now you're deliberating. Hey, should I go ahead and buy this $100 bond, or should I go ahead and buy Apple shares, where you can buy one share for $100? How do you make that decision? Okay. So, well, first you're going to evaluate your thesis on Apple, and you're going to come up with a target price for Apple. And you're like, okay, by the end of the year, I'm expecting Apple to hit $110. So you could buy Apple, or you could buy the bond for $110. What do you buy, Kusha?
Buy Apple or buy a bond for $110?
Yeah. So you could buy Apple, okay? Currently sitting at $110. $100. You have a target for Apple reaching $110, okay? Or you could go out and buy a bond that is giving you 10%. And if it's giving you 10%, it means that you're going to get $10 on top of the $100. So by the end of the year, you're going to have $110 to show for it, right? Yeah. So they kind of look like the same trade, right? But what would you buy? Which trade would you take? The left-hand side or the right-hand side?
It depends on the future prospects, right? I think just based on that, I would buy I'd buy Apple.
You buy Apple because of the future prospects.
Yeah, that's how to evaluate it.
That's how you'd look at it, right? So you're like, hey, the future prospects of Apple longer term is better than the US Treasury, right?
Yeah. Yeah.
But you're saying that the future prospects within a 1 year, based on this, you're saying that these numbers are telling you that the future prospects are the same. If you've come up with this target, okay, this is your target, Krisha. Your target is $110 by the end of the year.
Yeah.
So based on this, you're saying that the future prospects are the same for both of them, right?
I guess, yeah, because I'm buying Apple at 100, my target is 110, getting 10% on the 10-year yields.
What I'm teaching you guys over here to do is to think rationally and think critically about the decisions you guys are making, the buying decisions you guys are making, and where you guys might be going wrong, right? So Krisha is saying that the future prospects of Apple are better, but at the same time, her target is the same as the US 10-year. So is that your future? Is that you saying that the prospects are better within this target duration? Or is it you saying that, hey, over a much longer period?
Yeah, the latter, of course.
So what you are essentially saying, Kusha, is that you are willing to underperform in the short duration.
Yeah.
Regardless, right? Because is it really, like, if I had to tell you that you know what, you need to pull your money out of both of these options within 1 year, okay, and you are evaluated as a portfolio manager, you are going to be evaluated based on what happens after 1 year, not 5 year. You're not Kathy Wood here, all right? You're like every other lame-ass portfolio manager who cares only about what happens within 1 year.
Yeah.
Right? Because they are evaluated, their performance, their reporting, etc. is based on 1 year intervals. What if I told you that this is what you have to make your decision on? What would you do?
Then it's the bond, of course, because there's no risk associated with it, right?
Exactly.
You already have what is guaranteed to you, which is your 10%, versus Apple that would have a speculation risk associated with it, right? It could get up to 110, it could not get up to 110, but you know that the bond is like a solid sort of bet in that, okay, 10%, that is the, that's the rate that you're getting on it.
It's the risk-free rate, right? So, guys, the US 10-year is what you would call your risk-free rate, right? Exactly what Krisha just went through right now. She broke this down in her head on her own, came up with the same explanation of this term here that they use, the macro analysts use, the jargon that they use to complicate things, right? Which is essentially what she just said. There's no risk associated with this. That's why it's considered the risk-free rate, because the US government is literally going to print the money and give it to you. They can constantly print, right? And by the way, guys, when they say risk-free rate, they're talking about default risk, right? They're not gonna hard default because they can just print the money. That doesn't mean that they won't soft default, but that's a different topic for another day. So the US 10-year giving you 10% is essentially telling you that my risk-free rate is 10%. So everything is going to be judged based on that. Every portfolio manager is going to be asking that question. Should I take Apple at $100, currently priced at $100, if I think by the end of the year, I'm going to get $110 out of it, right? And they're going to say, a lot of them, Kathy would know. Kathy was going to say, no, I'm going to buy it regardless, because my horizon is 5 years, 10 years from now, 15 years from now, right? And that changes the math completely. But most portfolio managers are going to say, hey, no, I need to get more than this for me to make it worth it. Maybe they say, hey, for every equity, I need at least 15% to make it worth it for me, because there's a risk associated to Apple, right? And there's no risk associated to the 10-year, because Apple can't print money, right? That the US Treasury, or rather the Fed, the Treasury is going to go and talk to the Fed secretly and say, hey, you got to print money, man. And they're going to print money and give you the yield, regardless of whether they do well or not, regardless of whether they're running record deficits or not. They're going to keep printing and give you this guaranteed 10%. Apple's not going to give you a guaranteed target of $110, right? So you're going to say, hey, I want at least 5% on top of that. 5% on top of that, or my target needs to be 5% on top of that for this trade to be worth it. But if you evaluate the target at $110 based on the valuation of the company, your valuation is a fixed number, okay? You look at all the numbers on the balance sheet, on the cash flows, et cetera, and you come up with $110 as your target, right? You can't change the target. But what you can say is, hey, for this to become worth it for me, I need Apple to come down in price. I need this to go to $95, right? Because if it goes to $95, at that point, your target is going to be around 15%, right? At its current target, you're only getting 10% on Apple, which is not worth it, because the US 10 years giving 10%, right? But if it drops down to $95, at that point, it becomes worth it. At that point, you get to say, you know what? At these prices, Apple is very attractive to me, because my target for Apple is $110 still. That hasn't changed, right? But at $95, I'm getting 15%. On the 10-year, I'm getting only 10%. So Apple will become a better buy. And by the way, guys, when you do all of these numbers, right? When you do all this math, that's how support and resistance also gets formed. That's how all of these fundamental analysis tools get reflected on the charts. Because there are lots of bots and algos that are doing the same math, and they start buying at certain levels. And we see those levels get bid up. We see the big wick show up. We see the candle body closes, because let's say there's a level over here at around $95, right? And the market keeps buying it, and you see a candle close above it. That's telling you that all the FA analysts are saying that any price underneath $95, any price above $96, that's what I like, right? Or rather, any price underneath $96, that's what I like, because at that point, I'm getting 15% and above, right? So anything underneath, right? Anything underneath 96, all the way up down to 90, 85, it becomes a good trade, and they start DCing into those positions. It's a quick, simplified explanation as to how and why the 10-year yield is always going to be very, very important. If this number goes up, well, then equities are going to need even more on top of the 10%, right? Let's say this goes up to 15%. All right, let's go ahead and use my eraser tool. If this goes up to 15%, then people are going to be asking 20% from equities. Maybe, okay, depending on lots of other factors, but I'm keeping it very simplified over here, right? They're going to say, hey, I need 5% on top of my 10-year to make equities worth it. That 5% on top of the 10-year is called the risk premium, because this is a risk-free rate, right? This is the risk-free rate. Well, if I'm going to take on risk, I want a premium on top of that, right? So that's going to be 15% minus 20, a 5% risk premium, right? Also called the equity risk premium, ERP, right? Now, with this in mind, guys, if I know I can get 20% by trading equities, if the market is saying, hey, you should be getting 20% by trading equities, I can say, you know what? Crypto should give me even more. So we in Mango can come up with our own term and say we need a CRP, which is the crypto
Pretty cool.
risk premium, right? So this is how we need to think about things, guys. Okay, we're going to be more sophisticated than every other community. Okay, and we will know that every time we put on risk, we are getting our money's worth, our risk's worth, because we want to be as stress-free as possible, right? So ultimately, what we are looking for is the 10-year yield to have less risk than equities, and the equities to have less risk than crypto, right? Long story short, the 10-year yield is going to be the basis for every decision that most equity analysts make, and every equity analyst is going to be making their crypto decision based on whether or not they're getting too risky on equities or not. So if they already have such a big hurdle to bypass with the 10-year yield currently sitting at 4.334%, right? It's going to be tough for Bitcoin to catch a bid. The fact that it is catching a bid is really, really, really good. Right. But for Bitcoin, we're going to make an exception, and I'm going to explain why in the next stream. If you guys enjoyed this explanation, let me know in the comments down below, and I'll do more of these at the beginning of each stream.